Okay, welcome back, traders. It's John. I'm recording this on Friday, February 9th, on about 2 o'clock Eastern Standard Time. Presentation today is made by Rain King LLC, and I'm an amateur individual growth stock investor. So the agenda today is to take an update at the bull leg number 2. We'll look at market breadth. That's been a real hot topic on social media, breadth. We'll take a glance at the sentiment, and then we'll also look at trade management and wrap up. So bull leg number 2 update. We looked at this a couple weeks ago. I had pulled out some statistics from previous bear markets and looking at the first leg up, the first correction, and then the second leg up. So I've just updated the chart. I looked at the second leg up and I took the last 4 bear markets and looking at the second leg up, and I calculated roughly about a 29% average. So if you use that 29% average, you'll see that this leg could potentially get us up into the 16,181 area, which is right around NASDAQ new highs. So far the leg from the bottom has moved up 27%. So it's possible we're getting into a zone where old new highs might be an area to rest and digest the gains a little bit. But that's just a quick update on giving us a signpost. So market breadth. Hear a lot about that these days. So this is the S&P 500. I cut this chart around noontime. The S&P currently about 2 o'clock is trading around 5,022, starting to engage with the 5,000 level. I do think, we've come quite a ways. It's possible that we might get some pullback in here. I've just drawn a line. Roughly the 50-day moving average in red is where a 5% pullback would be, which would be, pretty normal, normal action. The good news is we've started to see new highs pick up again, which is a positive sign where we're not really getting good signs a couple of weeks ago. So that's a positive on the S&P. In particular, the XLI industrials are doing very well. So this 5,000 level in NASDAQ, actually Carson Research took a look at all the major milestones for the S&P. So you can see these milestones. Here's the 100 level, the 1,000 level, 2,000 and beyond, and the date that it crossed those. And what did the index do in the ensuing 1, 3, 6, and 12-month time period? Now, it's not a big sample size at all. It's only a few data points. But in general, even 1 month out, the index was higher. And all of the index returns for 3, 6, and 12 months were higher going forward. So S&P 5,000 may be something that passes fairly quickly, but we might noodle around here for a little bit before we get through with a convincing fashion. So let's switch over to the NASDAQ. I've been showing this chart. We've been tracking the past month some of the deterioration in the new highs. So I've just updated this. We spoke about this 2 weeks ago. We said we had new highs in the NASDAQ of 257 on January 29th. And here we are. We had new highs yesterday, February 8th. We had 253 new highs. So just slightly off. At least it's not deteriorating as we go higher. So that's a positive sign. We'd like to see the new highs get more steadily and more broad. We want the market to broaden out. It's still a stock picker's market, and we want to keep watching this carefully. Now, also looking a little further at the NASDAQ breadth, this is the stocks, the percentage of NASDAQ stocks above the 50-day moving average. So this is not a good look. You can see this has been deterioration since the beginning of 2024, and we're down to 41.8%. That admittedly is not a good look. We need that to turn around. There's a lot of stocks that have already been doing a lot of correcting. I mean, if you've been paying attention, even though the leaders are still moving higher, the IWM is corrected, the ARK K is also corrected, the mid caps have corrected. Now, these true market leaders are usually the last stocks that are going to pull in. So it's not unusual to see the strongest stocks still trying to make new highs, but we want to see the breadth start to improve a bit. You can see again here's the new highs on the NASDAQ and how the new highs are slightly going lower, stabilizing a little bit. So I called up the New York Stock Exchange advanced decline line, and I'm taking a little bit of a broader view. I'm going to a weekly chart. And you can see here that the weekly AD line looks fine. You have the S&P 500 moving to new highs. You see the new high points. We just hit a recent new high in the weekly AD line. So when you zoom out of all the noise of the daily events, the weekly looks fine. So that's important to note because I see a lot of people on X and Twitter and other social media really getting obsessed with breadth. And, you know, I wanted to say a few more words about breadth divergences. The first thing I wanted to say is, breadth divergences, and I watch them as much as anybody, they can put short-term pressure on the market and they can create pullbacks. But we have to remember in a bull trend, pullbacks are normal and pullbacks are healthy. 3, 5, 6% pullbacks are very healthy, and we need those along the bullish trend. Now, other breadth divergences, looking at a long-term signpost in terms of market tops, breadth divergences take many months to form before you have a major market top. And I'm going to share a few examples. But to put it in context, we're just starting a brand new bull market. We just have ended a 3-year bear market for growth stocks that started in February of 2021. We have inflation is curling down, so we have that tailwind. And we also know that the Fed's next move is going to be a cut. Whether the cut's in May or June or July, doesn't really matter. We just know that the Fed is positioned to cut at some point in the future, which is also going to be a tailwind for growth stocks. So that's good. So let's talk about these breadth thrusts and look at a couple of examples. Now, as I mentioned, breadth divergences are not a precise timing tool. So this is looking at the advanced decline line, and I'm looking at a couple of major market tops, the 98 top and the 2007 top. So this 2007 top, I'm showing the advanced decline line in this cyan color right here. You can see that the market was still trying to make higher highs, but it was almost 3 months of a deteriorating AD line before the market really broke down. And in 1998, again, we had a 3-month lag time before the advanced decline line was deteriorating for months before we really had the sharp bear market in the NASDAQ. So it's important to keep that in perspective. They're not precise timing tools, and we're really not anywhere near a major market top. We're just beginning a new bull market. And the last one I wanted to show you is the most recent. This is the 2021 top. So you can see here in 2021, the advanced decline line peaked out in April of 2021. And you can see I've marked all the new highs in the S&P. And you can see at each one of those, the breadth was deteriorating. And it went on for 6 full months before the S&P finally topped out. So I know there's a lot of chatter about breadth. We want to watch it. It certainly could take an effect in the short term and give us a pullback, but keep it in perspective. So I wanted to share a few names of interest that I'm currently in or I'm currently watching. If the market were to pull in here, there's some names that I'm really interested in. AMD had a very strong move up. If it can pull back to the 10-week line, I'd be very interested in trying to make a purchase. Mercado Libre, very similar. Pull back to the 10-week line would be very good opportunity to get into that stock. They have earnings on February 22nd. Now, CrowdStrike and Shop and Elastic, those are stocks that I'm currently have a position in. And so I am interested because I'm wanting to add to my position. So I'm waiting for CrowdStrike to pull back to the 10-week moving average. Its earnings are coming up on March 5th. Shopify has earnings next week. So I'm looking for an earnings reaction play as a possibility if we get a good reaction. And Elastic has earnings on March 1st. And I'm looking to add to my position if we can get a good earnings reaction. Now, the housing stocks have been pulling in the last few weeks. They've been basing. They're still very interesting. I'm interested in Toll and Pulte and D.H. Horton. A couple other stocks that are interesting. Confluent had an earnings gap a couple days ago. Coherent had an earnings gap. I'm interested in looking at those a little closer. And Stone could be interpreted as a high tide flag. They have earnings on March 6th. There are some other stocks that are in real good, persistent uptrends. Abercrombie, Nutanix, and some others. I'm looking for B&B pullbacks on those particular names. Now, B&B pullbacks and stuff like that, that's going to be part of my web service. I'll be sharing buy setups that I use that I really haven't shared in these market videos. I am working on the web service. I'm trying to get it ready for May. I want the content to be really good. There's lots to record and organize, but I want it to be really, really useful. So buy setups, sell setups will be part of the premium service. So that's in the works. Just wanted to give you a quick update. So let's look at sentiment. This is the American Association of Individual Investors survey that just came out on February 7th this week. Now, interesting, the bullish reading is 49%, which is pretty high, pretty elevated. It means retail investors are getting pretty excited about the rally. The other part of this that I thought was very interesting is the 1-year bullish high was 52.9%. And that came on December 20th of last year, where everybody was bullish. And interestingly, only 7 weeks earlier, we had the most bearish reading of 50.3 on the bear side, which was on the 1st. So it's interesting that in only 7 weeks, we can go from basically fear to greed. So this is a little elevated. This is the National Association of Active Investment Managers. I've shown this before. When you get into the green zone above 85% invested for these active managers, it tends to be where the market tends to have pullbacks. You can see the last time we were up in this green zone was right around last summer, and summer started that correction we had from July all the way down into October. So we're a little elevated on both of those from a sentiment point of view. But again, it's important to remember, sentiment is a tertiary indicator. I would never trade off sentiment. I would definitely use price and volume. This is really the third thing that I would even look at. So I wanted to get into a little bit on trade management. So as perspective, we're about 12 weeks into this rally and this uptrend that we're in. And, we could get a pullback, which I define as maybe 3 to 6%, or maybe we have something deeper, a deeper correction of 8 to 10% or 12%. So we've started here. The follow-through day was November 1st, and here we are this week. So about 12 weeks. So there's a couple scenarios. Stock A, you could have stocks in your portfolio that broke out relatively close to the follow-through day. I'm showing an example here of a stock that broke out in week 2, and it's had a nice run. Let's say that stock A is up 45%. That's a good move. Now, you might have bought a stock also around the follow-through day, and it started out of the gate pretty strong, and it was a potential leader, but it started to underperform and go more sideways. So I'm calling that stock C. Let's say that stock is still green. It's up 20%, but it's not really a true market leader. And the third is a laggard breakout. This is a stock that maybe hasn't broken out in this uptrend until maybe week 10, 11, or 12, late in the move. It finally breaks out, but maybe if the market pulls in, you don't have much gains. Maybe that stock only has about an 8% gain. So you become in a situation where you really have to evaluate and rank your stocks and mentally have a preparation for a pullback. I've shown this table before a couple of weeks ago. Do you have the sitting power to sit through a base? And this table is trying to show you, the blue shows you that if this is your gain in blue, and you have a correction in your stock of 15, 20, 25%, this is telling you a 40% gain and a 25% correction, your gains will be reduced to only 5%. So you have to consider that if a stock's going to go into a base and know if you're going to be able to hold it. So we also know that growth stocks will correct 2 to 3 times the NASDAQ. So if the NASDAQ in scenario A were to pull back 5%, your stock easily could pull back 15%. So you have to ask yourself, can and should you hold the stock? Do you have enough cushion? And depending on your concentration level, how much drawdown would that bring to your portfolio, and is that acceptable? And even imagine if the NASDAQ were to pull into a 10% correction, your stock could be down 25 or 30%, building a base. So it's important to mentally go through this so you're prepared with your plan. So in the case of the stock that was up the most, and I'm using the cybersecurity stocks here, the real leaders are Crowd and Palo Alto and Zscaler. And if we get a pullback, the stock could come back down and they could form a base, maybe pull back into the 10-week line. So that's one situation. Now, the stock that really has started to underperform and only has a 20% gain, and I'm using Qualsys from this group, has underperformed and it's starting to roll over. Okay, so if you might want to grab those gains if the market starts to pull back, because they're going to evaporate pretty quickly. You can see a 20% gain and a 15% pullback, you're going to be left with hardly any gains. Now, the laggard stock, which is only up 8%, you can imagine this is probably going to stop you out somewhere along the way because it's going to fall below the pivot. I'd consider Fortinet has not broken down, but it's in a base. What it hasn't even broken out really, had an earnings report that's still struggling to get out of a base. That's telling you that it's a laggard in the group. So stocks with only small gains, you might want to take those gains along the way. So it's a little bit about how you think through trade management and your overall portfolio. Now, why it's so important, because if you do have a Palo Alto or a CrowdStrike and you've got a big winner, I always say it's more important to play defense, 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 because you have to protect the big winning stock. So the example I use, let's say you caught SMCI and you've got some really big gains. You're doing really well and profits are literally pouring into the bucket from SMCI. What you don't want to happen is to be having a bunch of leaks in the bucket. If you're holding stocks that are not performing well, you're getting stopped out, you're holding losers, you're holding stocks that are leaking and taking losses after losses, you're just leaks in the bucket. You're trying to get your equity curve to fill this bucket to the brim. And you have to be very careful to manage your portfolio on the defensive side. You want these losses to be remain very, very small and controlled. Otherwise, the big profits from SMCI or another big leader are simply going to be washed out. So that's the concept of why we must protect our big leaders by playing more defense. I mentioned this already. Here's some names that I'm interested in. So let's wrap up. So the summary is, the NASDAQ is back at new highs. That's positive. We're starting to see the new highs stay stable, which is good. Key levels on the indexes are still supportive. We're still above the 20-day line and the power trend is still in place. So, we really, really want to watch price. Price is what really matters here. So don't get too obsessed with breadth. I mentioned it before. It's important to watch, and if things deteriorate and leaders start rolling over, I would get more and more concerned. New highs and new lows. Like I said, we had a weekly advanced decline line confirmation of the new highs in the S&P. That's encouraging. Some of the leading stocks are acting really, really well. We had a big blowout earnings report in ARM. Many leaders are moving to new highs, but earnings season has been treacherous. There's been hits or misses. So you got to be careful out there and know how much cushion you have and have a plan for how you're going to go into earnings. As far as the exposure levels, 60 to 80% is exactly what I had last week. I still think it's about right. I do want to have some buying power. If some of these stocks do pull back, like the AMDs, I want to have some money I can put to work to add to my winners. But I think we still need to be very flexible. There's no doubt there are caution signs that the market is getting stretched. Breadth we've hit 1,000 times in the video. But I think, don't get scared out of positions because of the chatter. So the quote of the week, all new highs are bullish, except the last one. We're hitting new highs, so take it what it is, watch your stocks carefully, and we'll have to see how this unfolds. That's the general market update for February 9th, 2024. Have a great weekend, everybody. We'll see you next week.